Ferrari continues to defy the industry trends with robust financials and a very strategic approach that keeps the scarcity high and the depth low. They can also deliver record-breaking margins and their order books are filled to the brim. And as a goodie for dividend investors, they could also increase the dividend by more than 70% per year for the last 5 years. So why is Ferrari thriving while other automakers struggle? And should you join the whopping 98% of Ferrari's employees that are already invested in the employer? Well, in today's video I'll break it down. I look at the business models and the markets of Ferrari, analyze their position by doing a Porter's 5 forces analysis, and look at their latest financial statements to see how they are doing. I'll also check their valuation and do a discounted cash flow calculation to determine their fair value. So sit back, relax, and let's explore Ferrari's investment potential together. My name is Florian, welcome to Cashflow Maniac. The ticker symbol of Ferrari is RACE, which is quite amazing, and they are listed on the New York Stock Exchange. They are working in the consumer discretionary sector and were founded in 1947. At the moment they have around 5,000 employees and their headquarters sits in Maranello, Italy. The market cap sits at $73 billion at the moment. So just in case you never heard of Ferrari before, they are basically a manufacturer of top luxury sports cars, a Formula 1 racing team, and they also sell their own designer collections. In 2023, the vast majority of their revenue came from car and spare parts manufacturing, around 85%, while around 10% came from sponsorship, commercial and branding business. This is all related to the sponsorship of the Formula 1 team and the sales of their designer collection. Around 4% of their revenue are made in the engines and other section. However, the engines business was mostly related to a deal with Maserati the company had, and this ran out in 2023. So in 2024, this engines business section will break away. As an Italian company, Ferrari makes most of their business in Europe, around 44%, while around 28% is coming from the America, mostly the US, 11% from China, Hong Kong and Taiwan, and around 70% from the rest of the APEC countries. What I find very interesting here is that despite being a top luxury brand, the presence in China is not that high for Ferrari. One thing that vastly differentiates Ferrari from other car manufacturers is the fact that they strictly limit the cars they produce. They are only selling approximately 8,400 new cars each year, and the number of cars produced for each model is rather counted in the thousands or even only in the hundreds for the top-line models. But why is this? One of the reasons for this is their dedication to craftsmanship and hand assembly. And in fact, the only part of Ferrari's manufacturing process that is 100% automated is the connection of the valve mechanics. All other parts, including the engine, are assembled hand by hand with exceptional care and meticulous quality control. The second reason is the dedication to value over volume. This gives the company a lot of pricing power and is one of the main reasons for the scarcity of Ferrari and the full order books of the company. In fact, in the last quarterly update, their CEO said that their order books are already filled till well into 2026 and that almost all of its models are already sold out. This is especially impressive in times where other car manufacturers are dialing back their production and lowering the volumes. Of course, this focus on quality and hand assembly is also reflected in the price of Ferrari, which for their standard models range from a couple of $100,000 until the range of $500,000. But this price is only the start. Especially when it comes to personalization and limited models, the prices can easily go up to several million US dollars. And this is not only true for new cars, but also for older second-hand Ferraris. The most expensive Ferrari was just sold last year for 51.7 million US dollars. So you can imagine that these cars can also work as a good investment if you have the spare change lying around. One huge risk for Ferrari is the adoption of EVs also for sports and super sports cars. In their company report of 2023, they even mention electronic vehicles 130 times. And even though Ferrari itself is seeing this trend as a risk, they remain dedicated to further diversify their lineup with more hybrid cars and even full electric ones. At the moment, they offer 4 hybrid models, and the first full electric Ferrari will be unveiled next year. In the last couple of years, they have also acquired land and built a new factory, and just next month this should be inaugurated. This new building is meant to produce electric motors, batteries, and everything else related to producing electric cars. Over the long run, they want to diversify their portfolio by using regular combustion engines, hybrid engines, but also electric engines. This is also quite important because if we look at the trend of cars shipped by engine types, we see that the shipments of the cars with hybrid engines have increased quite a bit over the last couple of years, while putting quite some pressure on the models with combustion engines. The forecast goes even further than that, and by 2030 they expect that around 40% of the shipments will be full electric, 40% hybrid, and only 20% of their cars shipped will have the regular combustion engines. Of course, a lot of the strategy still depends on the first full electric Ferrari that will be unveiled next year. So it still needs to be seen how this first full electric Ferrari is accepted by their customers. This focus on hybrid and electric cars is also quite important, because as McKinsey points out in this market research, we can see that over all different price ranges, the adoption of electric luxury vehicles from 2021 till 2031 quite significantly. And what is also quite interesting here is that except for the most expensive cars, the adoption of electric vehicles is actually increasing with the price of the cars. And in their base scenario, McKinsey is expecting that by 2031, around half of these luxury vehicles will be electric vehicles. In their accelerated scenario, this goes even up to around 70 to 80%. So there is definitely an increased trend to electric cars also in this top luxury segment. The overall luxury car market is expected to increase with a CAGR of around 7% until 2030 on a global basis, and around 6% in the US market. When we split this trend down to fuel or drive types, we also see that electric, marked in gray here, is expected to increase most until 2028. The biggest losers here will be diesel cars, but petrol cars are also not far behind, and their market share is also expected to fall over the next years. In this top luxury segment, it is also very interesting because these overall average growth numbers can vary quite a bit between the different price segments. And the biggest growth in this segment is actually expected in the very high-end range, where one car costs more than $500,000. But even the growth in the other luxury segments is well above the growth for regular cars. So I think it is fair to say that Ferrari can definitely benefit from a secular trend here, and as one of the top players in this high-end luxury market, the growth numbers for Ferrari should be quite impressive over the next years. Before we come to the financials of Ferraris in just a bit, let's also have a look at the strategic position by doing a Porter's 5 forces analysis. In this case, first of all, I estimate the threat of new entrants as medium. There are significant barriers in regards to vehicle safety and emission regulations, especially in the EU, that generate entry barriers for this market. Ferrari has managed to build a strong brand loyalty, and with its focus on personalization, they have a special spot in this industry. In the last years, though, we saw competition rising, especially from car makers in China that are also targeting this luxury vehicle market. This might also be one of the explanations for the kind of weak sales numbers for Ferrari in China. The threat of substitutes I would estimate as medium to low. As luxury products, cars or products in this segment are discretionary and can be replaced or left out easily. The brand recognition of Ferrari helps with this, and in 2020, 65% of the sales were even to repeat buyers. But with the rising concerns about emissions and global warming, consumer interest might switch away from Ferrari at any moment. The development to autonomous or even self-driving cars might also hurt Ferrari in the long run, and race investors should definitely monitor this trend. The competitive rivalry, on the other hand, I would estimate is quite high. The top luxury car market is very concentrated among a few players. This concentration and the brand recognition of most players in the segments make up for a very high competitive rivalry. The high influence of the general economy on this intensifies this rivalry only further. The bargaining power of the customers, on the other hand, is surprisingly low. The high repeated buyers indicate a high customer satisfaction, but also a limited number of buyers. But as Ferrari basically chooses who is allowed to buy a car from them, with loyalty programs and even kind of background check for their top luxury cars for their customers, the overall bargaining power of their customers is quite low. And this is also reflected in the fact that we just saw that Ferrari has basically sold out its whole production until 2026 already. The bargaining power of their suppliers, on the other hand, I would state as medium. Ferrari has a strong focus on the relationship with their suppliers, and they are also acknowledging their contribution. And despite the low production volume, Ferrari has actually established a make or buy strategy to manufacture some crucial parts by themselves. However, some of these components are special designs that are not easily available, so Ferrari is dependent on their suppliers, especially for these advanced components. Overall, even though this luxury car segment is highly competitive and new players are currently trying to push into the segment, Ferrari, as a top luxury car manufacturer with a great brand reputation and exclusive clientele, still has a great position, and I believe that there are not many companies out there that have such a moat so they can even choose their own customers. With many current changes, like the move to electric vehicles and autonomous driving, this industry is changing quickly, however. So it needs to be seen how well Ferrari can cope and adapt to these changes. So guys, if you do like the video so far and find the analysis helpful, please smash the like button and subscribe to the channel in order not to miss my next video. And let's get on with the financial analysis now. The performance of Ferrari over the last years was quite impressive. In the last year alone, they could outperform the S&P 500 by around 15%. Over the last 5 years, they could double the performance of the S&P 500, and over the last 10 years, they could even triple the returns of SPY. The fundamentals of the company are also quite impressive, and to me, this even looks very close to compounder quality. We have a very steady rise in all metrics, starting from top revenue, over net income, until free cash flow and operating cash flow. And even though we can see a little bit of fluctuations, the car industry is usually a very cyclical one. And compared to other car manufacturers, Ferrari almost shows no fluctuation at all. This is again a further indication for me that they should be counted rather as a top luxury brand instead of a car manufacturer. But not only could they increase their top line and bottom line growth, their margins over the last years did also increase quite a bit. Here we see a very steady uptrend in operating margins. For net margins, we had a peak in 2018, but since the dip in 2019, they could also recover quite a bit. And for the ROIC, it's actually the same. The margins of 20 to 30% are also quite high for the automotive industry. And of course, one of the most important metrics for investors, the earnings per share, did also increase over the last years. The same is actually true for the EBITDA, and the debt, even though we can see a slight upwards trend and a fluctuation from year to year, is still on a very manageable level. And right now, the non-current liabilities make up around 1.4 times their EBITDA. And this is even before subtracting the pile of cash that Ferrari has on their hands right now. The dividend payments of Ferrari are well covered by their free cash flow, so no concerns at all here. And over the last years, the company could also buy back shares on a regular level. And over the last 5 years, we had a yearly share dilution of minus 0.78%. So Ferrari is returning money to their investors on two fronts, by paying dividends and by buying back shares. Unfortunately, the analyst expectation and the forecast for the company for the next years is not as rosy as the last couple of years. Even though the forecast is expected to increase over the next years, this growth should slow down, and in 2027 the forecast is even expected to decline a little bit. And even though we still see some expected growth for EPS as well as for revenue, at least in the midterm, I think that this growth will be a bit slower than what we saw over the last years. And this is also reflected in the analyst expectations, where we see an upside of a bit more than 20%, but also a downside of around 18%. But we also have to say that Ferrari's own employees are seemingly not worried by this trend, as 98% of their employees are investors in their own company and have even subscribed to a share ownership plan. And Ferrari could also beat the expectation in almost every quarter. So I would also expect that this forecast is rather on the conservative side and that the company will probably deliver higher results than expected. The strong fundamentals and the moat of Ferrari have not gone unnoticed. And over the last 10 years, the valuation of the company has steadily increased. Right now, we are sitting at quite high multiples that are trading on the upper end of this range. For EV to EBITDA, we have a multiple of 36, PE 52, and price to cash flow 37.5. So compared to its own history, the valuation of Ferrari seems to be quite high at the moment. When we compare it to their peers, the picture is a bit differentiated. Here, I compare it to other car manufacturers that are operating in the luxury, but also the regular brand like BMW and Mercedes, but also to another top luxury manufacturer like Porsche. In addition to this, I also used Hermes as a top luxury goods producer because, as I mentioned before, I think that Ferrari should be compared rather to these top luxury brands instead of regular car manufacturers. And when we look at the valuation here, we see that Ferrari is actually trading quite close to the multiples of Hermes, but they are very far away from the valuation of other car manufacturers. So depending on who you compare it against, the valuation might be very high if compared to other car manufacturers, but it is almost on par, maybe even a bit cheaper when compared to other top luxury brands like Hermes. And in this comparison, we see that the multiples of Ferrari are even a little bit lower. The company is also a dividend payer with a very low dividend yield of currently 0.62%. And again, compared to their own history, this dividend yield seems to be about average. What is very nice to see in this case is that we have a very high 5-year growth rate of more than 17%, while still keeping a very low payout ratio of under 35%. So again, the dividend is very well covered. For the fair value calculation, I did use the average values for PE to free cash flow and PE multiples. And as growth rates, I used the growth expectations for the next couple of years. For the dividend growth rate, I assumed quite a bit lower growth rate over the long term compared to what we saw in the last 5 years, because I think that a dividend growth rate of more than 17% is not sustainable over the long run. So I assumed around half of this value of 8% here, which I think is still a very good dividend growth, well above the inflation. Unfortunately, even with these rather optimistic assumptions, the fair value of Ferrari is quite a bit below the current stock price. With this calculation, I come to an average fair value of around $160, and by including the margin of safety of 20%, we still sit at around $130, which is quite a bit above the $417 where we are sitting right now. But we can also see that the values from the discounted cash flow analysis are quite a bit lower compared to the multiple calculation. And even when only considering the fair value from the multiple calculation, while coming closer to the current stock price, we are still sitting quite a bit below. So from a fair value perspective, the company seems to be quite overvalued at the moment. Ferrari just experienced another stellar quarter, exceeding expectations in all areas. And although shipments declined, their margins still continue to grow. For most companies, this would be cause for concern, but for Ferrari, this is actually a positive development. Their order books are fully booked until well into 2026, and their management is determined to maintain this level of scarcity. Ferrari's fundamentals are solid all over the place, with good top and bottom line growth, and over the past years, they also could successfully expand their margins while keeping their debt in check. Ferrari is also paying a dividend, and they balance this smallish yield of around 0.6% with a huge dividend growth of more than 17% per year in the last 5 years. But even though Ferrari could deliver great returns in the last decades, the automotive industry is changing a lot right now. The trend to EVs and autonomous driving cars have a big effect on their business model. The biggest drawback, though, is the valuation. The valuation is very high when compared to its own history and also from a fair value perspective. It can only be compared to other top luxury brands like Hermes. So I think that Ferrari is a great company with a huge moat. But the current valuation is still quite a bit too high for me, especially when considering the risks that come with this technological disruption in the automotive market. So I am not invested in Ferrari at the moment. But please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys. If you did find today's analysis helpful, please smash the like button and subscribe to the channel in order not to miss my next video. And if you have any suggestions or recommendations of what I should analyze next, please leave me a comment down in the comment section. I'm trying my best to reply to all of them. And if you are looking for another company that might also fit your long-term portfolio, this one might just be the right one.